So one thing that people might think is, since I have this entity, this LLC, that I don't need to be concerned about the operating restrictions that apply for a retirement account like an IRA. And what we're saying right now is, folks, is you do, that those same restrictions still apply inside of the entity, in this case the LLC that we're talking about using here. So it's really, it's for an operating convenience, but the same sorts of restrictions still apply as far as what you can do. And again, when you're working with retirement accounts, it behooves you to be very careful, because if you make a mistake, you can disqualify the whole account. That means that it will be considered to be taxable income to you now, and you could be subject to many penalties, not to mention having to pay a lot of taxes, which is not fun.
Yeah, that's right. Well, the other thing is you want to consult with your CPA and your attorney who's knowledgeable in these areas before you make any investment decisions.
Mm-hmm.
You also want to be very careful not to overextend yourself. One of the classic problems people run into is you cannot put personal money, after you've set up your LLC, you cannot combine personal money after the fact, or in any way intermingle your personal money with your IRA money. So people who, let's say, put $100,000 into an IRA and go ahead and invest it in property, you run into a problem where all of a sudden you need to fix a leaky roof. You cannot get extra money and put it in to fix the roof.
Can't take it out of your personal savings account.
So you have to plan ahead, you have to budget, you have to pay attention. But it can be a lucrative return, because the return does come back with the advantages of being tax deferred or tax free if it's a Roth. And you can make some substantially good returns on your investment if you do it properly.
Okay. So now we'll get into another little weird area of all of this, and that is unrelated business taxable income. So maybe we can talk about that for a few minutes. And you may, if you want, you can throw some of it back to me, but anyway.
Well, actually, I'm going to throw it all back to you. I will say that the UBIT, or the unrelated business income tax, it does apply if you leverage your funds. The good news is you can use your IRA money to borrow money to extend it. So let's say the maximum you have in your IRA is $150,000, and you see that wonderful chance of a lifetime to buy that investment property for about $300,000. That's probably the most you can go, because you have to come up with approximately 50% of the cash nowadays. But you borrow the money. The nice thing is that they don't look to you as an individual for your qualifications. It looks to the deal. The lenders, there's a couple of lenders now that will provide funding for this. But the problem is, if you're investing, let's say, in a business, you're going to start to derive some income from that as a result of leveraging your IRA, and the unrelated business income tax will apply. And I'll let you do the calculation. Most people, we see their eyes start to glaze over when we cover the details, but it's something to watch out for.
Yeah. Well, I think, again, the thing to be aware of here is, again, people think that because things are inside of a retirement account, that means that it can't be subject to any tax.
Right.
As we've already pointed out, well, there are these fees and taxes that can apply for California, but depending on the activities of what you're doing, you can also be subject to a tax. So one is, again, we talked about leverage. So if you leverage, you borrow money in order to buy real estate, and then you get rental income from that real estate, and if it generates net income, in other words, income exceeding its expenses, then the IRA or the Roth can actually be subject to an income tax, okay? And that can apply for both federal and for California. Now, another thing, though, is that people don't talk about that much that are involved in real estate, that maybe they should, is that it can also apply just if it's a business activity. So one thing that people talk about in investing in real estate is quick flip type of operations. So you're buying and selling properties rapidly. That means that you're not making a long-term investment. You're not really generating rental income. you're buying a property and selling it, that can be considered to be a trade or business. That net income can actually be subject to an income tax. And many people blow it off, or they may think, okay, I'll tell you what, I've got 6 different IRAs, so I'll buy 6 different properties, and that will solve the problem. And the problem is that the IRS views all of your IRAs to some degree as one. So they can collapse that so if they see that you're doing this as a way of trying to escape this tax, if they catch it, and they can from property records, they can see that you're buying and selling properties, then there's a possibility that you could be audited and they could develop this tax bill for you. Not a lot of fun, so just be aware of it. This is not something that necessarily is going to disqualify your account, but it is going to make it more expensive, and so you may not be getting some of the tax benefits that you were hoping from if you're thinking, oh, I'm going to shelter this here. In fact, you could end up with a double tax, because if you've got a regular IRA, it could pay an unrelated business tax, and then it makes distributions to you which are taxable.
Right.
Oh,
I think
boy.
the primary advantage of the checkbook LLC and the whole self-directed IRA, the self-directed IRA gives you one higher degree of control over your IRA funds, and that's been the sort of the discovery of this last few years.
Yeah.
Although it's been around since 1974, as I said,
Yeah, but
only
it seems
people
like
are,
there's been a boom, though.
right. People are just now beginning to realize that we have a lot of baby boomers who have recently left their jobs and are now eligible to roll their 401ks into a self-directed IRA. The checkbook component lets you take that degree of control one step further, and it is unique. It's not for everyone. I want to emphasize that it's not for everyone. I've seen people thinking, oh, we got access to a couple $100,000. They have to know what they're doing, and it's really worthwhile. The last thing I would caution people is that certain advantages you have with regular investments, such as depreciation expenses or write-offs against normal losses, you cannot take advantage of if your money's in a self-directed IRA. So there are certain downsides to using that, and I would, after discussing that with people, sometimes they change their minds. And
Yeah. So in some cases, real estate investments actually generate losses. Because of the depreciation deductions, because of the property taxes, because of the interest that you pay. In many cases, I mean, we talk about, only recently have we been able to, in Silicon Valley here, Santa Clara County, to see positive cash flow actually happen with investments. So before that, people were generating losses initially with their real estate investments. Those losses, there were potentials for getting that as a benefit on your personal tax return. Now it would be locked up inside of your IRA if you in fact set up one of these operations as we're suggesting. So you have to look at the economics of your deal.
Right. One of the best uses I've seen people use is simply loaning money. You know people you get to work with and comfortable with. You can use your IRA to loan them money at a very nice rate of return. You can secure it with a deed of trust and a promissory note, and usually short-term 6-month to 12-month loans are generating very nice returns that you can do over and over again with people that you come to know, and you can make them secured loans. Very easy to do, very simple. You don't get involved in having to deal with toilets, tenants, and trash as the three T's of real estate investing.
Yeah, so that's a good point. And also, another thought, folks. So first of all, interest is not unrelated business taxable income.
That's right.
And you can structure to participate. You can have an equity participation that's built into a note, so that it's actually considered to be interest, and you can get some of the gain at the time that the property is sold, and it will be sheltered inside of your IRA or your Roth. So I favor this type of a thing, because then you don't get a lot of the other complexities of being involved with a business operation, or even just operating a property. Like you said, the headaches of managing it and dealing with complaints of tenants and that sort of thing. So I'm glad that you brought that up. It's an excellent alternative.
I like keeping it simple.
Yeah,
Most people,
me too.
people do it, and you can do it with a wide range. Again, the same restrictions apply. You cannot loan money to your mom or dad. You can't loan it to your kids. Ironically, you can deal with your siblings, but the reality is you want to make sure you're dealing with reliable people, that you do it properly with the right notes, and make sure that you do all the things and treat it as a serious business, and understand you may have to take legal action to secure it. So dealing with people that are just good friends and good buddies. You want to go beyond that and make sure that it's a secure investment. It is your retirement income, and you want to take care of it.
Right. So you don't want to trash your retirement account, and you don't. Well, there's the old saying, neither a borrower or a lender be. Well, a lot of that had to do with your friends, because it's a good way to ruin a relationship.
Yes.
So really, David, we're about out of time. Maybe you can offer, one or two final thoughts, and we can wind this thing up.
Yeah, basically for most people, people learn that they can use their IRAs and can roll it up and make money in real estate. They're very excited when they hear about the great prices out there. They know that it's difficult to get a loan, and they look into their IRAs and they start to see a lot of money. A little planning goes a long way. It doesn't have to be real estate. I recently did an LLC for some oil and gas exploration, which has a very nice return on investment. But it's designed largely to also serve as a write-off, as a loss leader for other investments. Make sure you follow the steps. Make sure you understand that this is a business, and consult with a professional before you jump in. This is something that can be very lucrative, and people that have done it properly come back time and time again and say this is a great way to use their IRA money, better than stocks and bonds, and they have fun doing it. Doing it wrong, you lose the money, and it's a very unhappy story. So keep it positive, keep it simple, and make sure that you do it right.
Right. So sometimes it can pay off, particularly when you're doing things with the money that you understand, as opposing to doing things that you don't understand, and having that possibility for loss. So, folks, we hope that this has been helpful information, a good introduction to this area for you. Opens your mind a little bit about what you can do with retirement accounts. The question is, of course, can you get money from that 401k? Some employers will permit you to take it out early, some will not. But certainly when you get into retirement mode, then you're going to have more flexibility with what we've been talking about here today. So, but get that professional help, okay? And with that, we'll see you next time on Financial Insider Weekly.